Welcome. Hi everyone. Welcome to ACCA Financial Reporting Paper. I'm Matthew Kaberenga. I'm going to take you through the financial reporting live sessions. Right. Today we are on revision. We are doing a major chapter which is consolidation. Other topics are not demanding as this one, because in the exam you'll be given a 20-mark question on section C. If your paper you don't find consolidation on section C, just know that it will be there in the multiple choice. You'll be given many multiple choice questions, objective test questions on consolidation. And if you don't find consolidation on section C, even on section A or B, that's not an FR paper. So this topic is one of the favorites of the examiners. Right, so together we are going to normalize the abnormal, right? So when you are given a question that is so much pegged in the FR exam, when you are given a consolidation that is so much pegged in, do not hesitate from today onwards, because I'm going to take you through every stage. I'm going to take you through every step, baby steps. We'll surely get there, right? So this is what we are going to do. We want to do this statement of financial position. Consolidation means adding together. So we want to consolidate the financial statements of a certain company, for example, company A and company B. Right, when a company acquires another entity, when it gains control, it means that company is now called the parent, and the company that is being controlled is called the subsidiary. Right, so if you invest more than 50% shares, you are the parent and that company is the subsidiary. So if your investment is less than 50%, if it's 20 to 50, you are an associate. So you need to apply the principles of IFRS number 10, consolidation, right? So we want to look at question. So today I'm using Kaplan textbook. I do use both books, which is the BBP and the Kaplan. So you have to play with your textbooks, you have to play with your revision kits for you to pass the exam. But what you must know is time is of an essence. For you to pass the FR paper, you need to manage your time carefully. So you need to keep your eye on the clock when you are in the exam. Writing is about speed, it's about time, because I've discovered that most people, they might spend even an hour doing consolidation. Imagine your exam is 3 hours and you are spending 1 hour on a 20-mark question. Yes, it's important. We know that consolidation is important. We know that consolidation is demanding. But you can't spend an hour on a 20-mark question. You won't be able to pass the exam overall. So you need time. You need to manage your time. Time is of an essence. Right, so you need good speed and good success for you to pass the FR exam. Right, so on consolidation, let us not waste time and get into the question now. Kaplan textbook, we are looking at text understanding number 4, peppermint. We have peppermint and spearmint, right? So these are the workings that you must master. You must know that on working 1, you calculate the group structure. You need to know the group structure, the percentage that was invested by the parent is very important, and the date of acquisition. Especially when you are doing FR, it's important for you to know the acquisition date and the reporting date, because this will help you even to calculate the depreciation charge. If there is any depreciation charge that arises because of the increase in the value of other assets, right? You need to know the W2 net assets of subsidiary, yes, which is the acquisition date and the reporting data. You need to know that, and you need to know the working 3 goodwill, where we calculate the intangible asset. You need to know working 4 and working 5, working 4 NCI and working 5 group retained earnings, right? So let's look at the question now. So let me read. Peppermint acquired 80% of the share capital of Spearmint 2 years ago. So they are telling us that the company acquired 80%. So 80%, Peppermint acquired 80% 2 years ago. So this shows that the 2 years ago is we acquired 2 years ago. the acquisition date 2 years ago. If you look at the question, the reporting date is the 31st of December 2004. This shows that the acquisition date is 1 January 2003. So from 1 January 2003 to the reporting date, we do have 2 years. The war of 2003 and the war of 2004 makes it 2 years. Right. And they are telling us when the reserves of spearmint stood at 125,000, the reserves, those are the retained earnings, the retained profits. Peppermint paid the initial, oh my God, we are not given the purchase consideration. So when we are not given the purchase consideration, especially if it involves the calculation of deferred consideration, just know that there's going to be a lot of fun. And what do I mean that? What do I mean by that? It's not going to be fun at all, because there will be some of the questions that are very tricky. So now they are saying Peppermint paid initial cash consideration of $1 million. Yes. Additionally, then they issued shares. Okay. Then there is also a certain amount of 500. It's 500 that they said they will pay in 3 years' time. That's fine. We're given the interest rate of 10%, and they are telling us that the appropriate discount factor of this. Okay. Then I'll explain that when we are now looking at the goodwill. Right, so if you look at the financial position, we have the first column for the parent and the last column for the subsidiary. Consolidation is just adding together the amounts of the parent and of subsidiary, and you get present as a single economic entity. Easy stuff, easy peasy. Right. What about the adjustments? The further information is also important to always read the further information before you before you answer the question, so that you won't omit some of the adjustments. On note 1, they are telling us that at acquisition fair value of spearmint plant. So note 1, we have the asset, the plant that exceeded the book value, right? And its remaining life for 5 years. On note number 2, they are talking about the brand and its remaining useful life. Note number 3, they are telling us about the impairment of goodwill. Note number 4, they are telling us about the value of NCI, and they are telling us that they are using the fair value method, right? What I've noticed is on this question, we are not given the PAP, the provision for unrealized profit. So we are not going to calculate, so we are not worried about the amount that will go on whether to W2 net assets on whether the group reserves. So we don't have the PAP. So we only have 4 adjustments, and so since there is no PAP, it's because they don't have PAP because they did not sell the goods to each other. So since there is no PAP, it shows that even they are not owing each other. We don't have that kind of intra-group transaction, right? So allow me to calculate W2 net assets of subsidiary. Why do we prepare the net assets of the subsidiary? It is because we want to value the company of subsidiary. We want to know the value of the company at the date that we acquired. So we need to know at the date of acquisition what was the value of the company that was acquired. What was the value of the company of Spearmint, which is our subsidiary. So on working 2, we only record the amounts of subsidiary. You don't record the amounts that relate to the parent, right? So when you want to value the company, you look at equity. What do we have? So you go to your financial position. Yes, I'm now comfortable to even just use the financial position even to do my workings, because I've read all the further information. So any adjustment, I'll adjust it on the right working. So now on equity, I only have 2 things: the share capital and the share premium. So I'm going to pick or to take the one that was on the last column, because that's for subsidiary, not for the first column, right? So we are taking the amounts from the last column, which is the 500 and the 300. So I need to write the dates. Dates are very important. Acquisition date, that's 1 January 2003. Reporting date, that's the 31st of December 2004. We have 2 years here, because they told us that we acquired 2 years ago. So dates are very important. Now we want to record on the amounts on the acquisition data. So what about the share capital? Yes, you have given us the amounts on the reporting data. What about on the acquisition data? Capital is capital. Capital doesn't change. It doesn't matter on which data. So capital always remains the same. So we have 500, we write 500. Then the RE representing the retained earnings or the reserves. Right, so these are the profits. Profits, they do change sometimes. You might make high profits sometimes. You might make low profits, even losses. Right, so you need to read the question on order to see if you are given the retained earnings. On this question, test your understanding number 4, we are given the reserves. They said that we acquired 80% 2 years ago, when the reserves or spearmint stood at 125,000. So the amounts that are in this, that are in the working tube, we have removed 3 zeros. So if you take any amount that is not from the financial position, you have to remove 3 zeros, like remember. So you put 125 here, that's it. Is there any fair value adjustments of assets? Yes, it is there, because on lot 1 you've discovered that the fair value of plant exceeded the book value. So the book value, another name, that's what you call the carrying amount. So you've discovered that we have a plant that have exceeded the book value. Since they are saying it has exceeded, this indicates that the asset has increased in value as compared to the amount that sits in the non-current assets. So we have an asset that has increased in value by how much? By 200,000. So I have to write this adjustment. This is for plant, which is 200,000 here, 200,000 here. So you have to record 200,000 on the acquisition date and on the reporting data. Yes, 200 here on the acquisition date we have adjusted. On the reporting date, these amounts are not updated. So you also have to record the 200. But you don't just recognize 200 like this. Because if you write 200 like this on acquisition date, then on the reporting date, you then write 200. It seems as if your asset is not losing value. So if you compare the acquisition and the reporting, there is 2 years. So you can't say we have a value of 200 here, then after 2 years, it will still remain with a value of 2 years. So the asset should depreciate, because it's not land. All assets, they should be depreciated. So allow me to record depreciation of plant on the last column. Because the 200,000, this one, the asset after 2 years, it will get depreciated. So you take the 200 divided by the useful life. They are telling us that the useful life is 5 years, you divide by 5. Then, if you do like this, I've seen that most students, what they do, they don't master, they don't read the data. They just take the value of the asset and divide by 5. Then they record this amount. So someone might say 200 over 5, someone might say 200 over 5. That's 40. Then they record 40 without reading the dates. You need to read the dates. So if you compare from this to this period, we have 2 years. So you must depreciate your asset over 2 years. So you multiply by 2 years. So that will be what? 40 by 2, that will be 80. And it's in brackets because it's a depreciation. It will reduce the value of the company, right? So that's it. That's easy. So make sure you read the data. If, for example, if we have a difference of 6 months, so you multiply by 6 over 12, right? Then also on note number 2, they told us that Spearmint had been selling some of his product under the brand name Mint Fresh, right? At the date of acquisition, the directors of P valued this brand. This brand was given a value of 250. The brand is an intangible asset, right? And they are telling us that it was not included in the financial position. Therefore, you must include it, right? So I'm going to recognize the brand of 250, 250. You apply the same concept. If it has 250 here, after 2 years, it can't remain with a value of 250. Since it's an intangible asset, I'm not going to use this terminology, which is called depreciation. I'm going to change the terminology, and I'm going to call it amortization. So your brand must be amortized. So amortization of the brand amortization of the brand, right? So this is 250 over the useful life. They are telling us that it has a useful life of 10 years. But don't forget the period, you must give an amortization of 2 years. You multiply by 2 years. If you do the number crunching, I'm pretty sure that you get the amount of 50 years. That's it, that's all. So we've solved note 1 and note number 2. How many adjustments we have? We do have 4 adjustments, so I'm done with 2 already. So 2 left. So then let's do the number crunching, and if you sum up all these amounts on the acquisition date, you get something like 1075. Easy peasy. Then on the reporting date, if you sum up these amounts, you get 1120. So this shows that at the acquisition date, the value of the subsidiary was 1075. From that date, from the date that the parent invested the money and up to the reporting date, it shows that the subsidiary company's value has increased now. It has increased by how much? So we need to know the increase in the value of the company. The subsidiary is increased by 45,000. So the 45,000, that's the profit, that's the post-acquisition profit. So if you are the parent, if you invested 80%, you invested 80%, that means you get 80%. So we are going to give 80% to the parent, 80% of this amount. The remainder will be recorded to the NCI, to the non-controlling interest. Then we move on to the goodwill W3. And when we are doing consolidation, goodwill will be recognized in the business combination. Yes, it should be recognized. It's an intangible asset, right? So the purchase consideration, we were not given the purchase consideration. If you read your question now, they are telling us that we paid this amount, we paid this, we paid this. So we need to know the total amount that was paid by the parent, or the total amount that was charged. So they are telling us that Peppermint paid initial cash consideration of. So we have the cash consideration. We have cash consideration of 1,000,000, 3 zeros on the top. What else? And they are telling us that additionally they issued shares. So we have the issue of shares. How many shares were issued? We issued 200,000 shares. 200,000 shares multiplied by. Right, it is the parent that acquired. So you multiply by. What do you multiply by? You don't multiply by the nominal value. The nominal value, that's the value that is in the books, right? You multiply by the market value of the parent. So the market value of the parent, they are telling us that is $80. So don't forget that there is an increase in share premium. Because the nominal is $, then they issued the $80. So there is a share premium. We are going to account that in the financial position. Right, so 200,000 multiplied by $80. If you multiply, you get 360. Then they are telling us that it was also agreed that Peppermint would pay a further 500 in 3 years' time. Right. So Peppermint agreed to pay a certain amount in the future. The amount that you promised to pay in the future, we call it deferred consideration. Deferred consideration, this is the amount that you promised to pay in the future. So they are telling us that the Peppermint promised to pay 500,000 in the future. So deferred consideration. So, but I'm not going to recognize 500 because the 500 is the future value. So we have to apply the time value of money, the assumption that the dollar received today is worth more than the dollar that will be received tomorrow. So if I owe you, for example, if I say, should I pay you next month or after 3 years, you would want your money now because you know that money loses value with time. So since the parent has promised to pay 500 in the future, it means after 3 years, it will be worth less. So we need to know that, what about the dollar now? Then after 3 years, the dollar that can be received now, will it be equivalent to $? Or maybe, let's see the question. So they are telling us the appropriate discount factor for dollar receivable 3 years from now is 0.75. So they are telling us that the dollar that you might receive now, after 3 years, it might be worth 0.75. So that's the time value of money. Yes, obviously, the parent is going to pay 500 after 3 years, but it won't be worth 500, it will be worth less. So they told us that the dollar will be worth 75. So that means if the dollar will be worth 75 cents, what about the 500,000 will be worth what? The 500 will be worth 375. That's the present value. So that's it. So on deferred consideration, you are recognizing the deferred consideration at the present value after you discount. So someone might ask a question, what about if I am not given the 0.75? If you are not given the 0.75, you can calculate this amount. If you are not given, this is easy to calculate. There is a formula that you use. If you are not given the 0.75, you use this formula. Yes, you must know it by head because it won't be given in the exam, which is 1 over 1 plus r to the power n. So 1 over 1 plus r. So they told us that the rate, the discount rate, or the current interest rate, or the discount factor is 10%. So 10%, this will be 0.1. So I've seen many people making mistakes. If you are not so sure, you use your calculator so that you won't make mistakes. Then to the power n, n is the number of years that you want to pay. The parent promised to pay after 3 years, so to the power 3. So if I solve this in brackets, this will be 1.1 to the power 3. Then if you divide, if you use your adding machine, you get 0.751. So to the 2 decimal place, that will be 0.75. Easy peasy. Right, to move on. Then, so this is the purchase consideration that was paid by the parent. Then you must recognize the fair value of NCI at acquisition. So this is given on which note? This is given on note number 3, so which is 380,000. So you recognize 380. So I'm done with note 4. So only note 3 is not yet adjusted, right? Easy peasy. Then, so if you recognize these amounts, we now want to compare with the value of the company. Because when you talk about the purchase consideration, we are talking about the amount that was paid by the parent. Now it's now versus what? Versus the value of the company at the date that you acquired. So we need to know the extra amount that you paid when you acquired the company, right? So you say less the net assets of subsidiary at the date of acquisition. As you can see, the net assets at acquisition is 1075. So I have to remove 1075. I will deduct, then I will get the goodwill at acquisition. What will be the goodwill at the date of acquisition? Right. If I do the number crunching exercise, I'm getting 1040. But the goodwill should be impaired. So we have note number 3. They are telling us that the goodwill should be impaired. So at the date of acquisition, we have seen that the goodwill is worth 1040. So, but it can still remain with 1040 even after 2 years at the reporting data. It must be impaired. So less the impairment loss. There is an impairment loss of 258. Then your goodwill at the reporting date, it will be 782. I'm done with working 3. Now on working 4 and working 5, I'll just kill 2 birds with 1 stone. NCI at acquisition, this is given, this is 380, even is the same that amount that we have recorded in working 3. So working 4 NCI, working 5 group retained earnings. The parent has these earnings of 1.4. So when you want to know about the parent, what we are concerned about, it is the profits that were made by the parent, because the parent is the one who invested, right? So this is the profit of the parent, 1.4. What do we have to add? You add the post-acquisition profit, right? The post-acquisition profit Parent invested 80%, so we are going to give the parent the 80% of this profit, which is the 45. Then the remainder, the post-acquisition profit, which is the 20% of 45, the remainder will be recognized to the NCI. The remainder will be recognized to NCI. So this will be 9, this will be 36. So it's always wise to confirm. If you say 9 plus 36, you must get 45. So this helps you to ensure that you've not made any mistake. Right. So that's it. So we share the profit. What else? And what is it going to affect? What is going to affect our profits? What is going to affect our retained earnings? Even the impairment loss. So you less the impairment loss. So 80% of the impairment loss of 258. So the loss affects the profits of the parent, the profits of the group. This is the group retained earnings. So the group is affected by the impairment loss. But I'm not removing the whole amount because they are using the fair value method. So the fair value method was fair. You remove 80% here and the 20% goes to NCI. If they have said that, let's use the proportionate of net assets, that's when you deduct the whole amount of impairment loss. So let's share the loss. This will be 2206.4 less impairment loss. This will be what? 20% of this. This will be 51.6. So make sure if you are deducting when you are doing a calculation, make sure that you are not adding. Make sure that you are subtracting. Right. So then on NCI, there is no any other adjustment that affects the NCI. So let me just add the total 337.4 easily. Then on group retained earnings, what else is going to affect our profits? You can verify, you can check. What else? Impairment loss we have accounted because it affects our profits. We have deferred consideration, right? So there is deferred consideration, the amount that you promise to pay in the future. So there will be an unwound discount, there will be an interest on the deferred consideration. So the interest goes to the profit or loss. So therefore it's going to affect the retained earnings. So allow me to recognize the interest cost on the deferred consideration. So less the interest cost on deferred consideration. On deferred consideration, right? This interest cost, you have to check your debts. You acquired 2 years ago. 2 years ago, right? So allow me to recognize the interest for the first year and the second year. For the first year, if you look at your question, you promised to pay 500 in the future, and they are saying that the current interest rate, it will be 10% per annum. So that means you'll be charged a 10% interest. There is the 10% multiplied by the present value. You multiply by the present value because you don't use the future value, use the present value, which is the 375. So 10% of the 375, that would be 37.5. If I round off, allow me to recognize the 38, right? Then the second year, there is the 10% multiplied by the present value, right? Remember now you are on the second year. So you ask yourself a question that, how much do I owe? So when you are in the second year, you can't say you can't say we owe 375 because last year, which is the first year, we were charged an interest of 38. So therefore, the amount that we owe right now is 375 plus the interest of 38, which makes the present value to be 413. So it's the present value plus the interest. So therefore, the interest that will be charged this year, it will be 10% multiplied by 413. 10% by 413, there is the 41 interest. Right. So that's all on working 5. Then you sum up 1.4 plus 36 less that amount, less that interest, and definitely that one, then you get 1150.6. So those are your workings, working 1 to working number 5. So I'm taking time because I am explaining, but when you're in the exam, don't forget that time is of an essence. You need good speeds, right? So now consolidation, statement of financial position. I'll start with the non-current assets. Non-current asset, the first thing that I'll start with is the goodwill. Allow me to recognize the goodwill, which is the W3. So this is 782. So when you are preparing the financial position, just know that from primary school learning, yes, you learn that the assets is equals to equity plus liability. So that means the left-hand side has to equal to the right-hand side. So we are starting with the asset side, right? So goodwill, that's 782. Then consolidation means adding together. So you just copy and paste from the statements, right? So we do have PPE. We open bracket. The amount for the parent plus subsidiary. That's PPE. Is there any value? Is there any adjustment? Any amount that we must adjust on PPE? You look at your working 2, you play with the reporting data. This shows that the asset, the plant increased in value by 200. So plus 200 W2 less the 80 W2. I'm not going to recognize brand within PPE because PPE represents tangible assets. Brand is an intangible. So I'm going to recognize brand separately. So there is the value of 250 W2 less the 50 W2. Easy. You then sum up. I'm getting this amount, and obviously this will be 200 common sense. Then current assets, your inventory. Why do we have 550 and 500? Then just know that there is 0 PAP. We don't have any PAP, so no adjustments. So this will be 650. Trade receivables, 400 plus 200. There is no intra-group, so this will be 600. The cash balance, 200 plus 50, that will be 250. Then the total assets. What am I getting? If I sum up, I'm getting 9602. Right. Then another heading, equity and liabilities, which is the right hand side. Then I'll start with the equity. On equity, with the share capital and the share premium. Right. On share capital, we recognize the amount of the parent, even share premium, the amount of the parent. Why are we not adding those of the subsidiary? Because the share capital of the subsidiary and its retained earnings, we have already accounted those amounts in working 2, right? So I only need the one for the parent. So the share capital for parent, that's 2,000. So that's 2,000. So this is 2,000. What about the share premium? On the question we have 0. But I want to adjust. Why? Because when we purchased the subsidiary, we issued shares. So this shows that the group now have further shares of 200,000, right? So plus 200 shares. Yes, sir. So 2,000 plus 200 multiplied by the nominal value of dollar, you get the 2.2. Then what about the share premium? Share premium was not given, but there is a gain that was made because the value, when we issued the shares, it had a value of $80, right? So the nominal value is dollar, the nominal is dollar, and the shares were issued at $80. So the difference is the premium multiplied by the number of shares that were issued, multiplied by the 200 shares. So the difference multiplied by the 200 shares, we have 160. 160, that is share premium, right? Then on non-current liabilities. So what I want to do is I want to account the deferred consideration separately. So I'm not going to add it here. So the 3,000 plus the 400, that will be 3.4. Then the current liabilities, 1250, you add with the 650. 1250, you add with the 650, that will be 1.9. Allow me to account the deferred consideration separately. Remember, we said that we don't recognize the future value because the parent has promised to pay 500 in the future, but we must recognize the present value of 375 here. 375. But is it the total amount that you owe? The total amount that you owe is not 375 because there were also interests that were charged, right? There were also interests that were charged. So the deferred consideration, which is 375 plus the interest, which is this amount, which is the interest. Interest in year 1, 38, this relates to year 1, plus the 41, which relates to year 2. So if you sum up the amounts, so 375 plus 38 plus 41, this will be 452, 454. Yes, sir. So that's the amount. Then, okay, allow me to do this. Let me adjust this. The current liabilities, this is 1250 plus 615, that's the CL, 1.9 here, then 3.4 here, which is the 3,000 plus the 400, which is the non-current liabilities. Why am I doing this? Because we have not recorded the whole equity. There is also need to account the retained earnings. So just know that when you are preparing the consolidation, you must have working 3 in the statement of financial position, the goodwill, and the retained earnings, the working 5. So you can't only have working 3 and working 5. Where is the working 4? You need working 4, which is your NCI. Right? So working 4 and 5, so NCI, that's, what is the NCI value? That's 337.4. What about the retained earnings? 1150.6. So this will be your total equity and the liabilities. Let me do the number crunching. 1150.6, 337.4 plus 3.4 plus 1.9. You sum up all these amounts, you get something like 9602. This agrees. The left hand side equals the right hand side. So that's it. You need practice on consolidation. You need to get used to the working one, which is the group structure, working 2, working 3, 4, and 5. And make sure that when you are doing consolidation, you do all the adjustments. Yes, you read the question first, do all the adjustments, then you prepare your statement. But what's key is the time management. We need time management. Keep your eye on the clock so that you'll be able to finish the exam. So that's it. On the next revision, we'll also be looking at a question where we also have the parent and the subsidiary selling the goods to each other, where we also have the cash in transit, where we also have the PAP and other adjustments. So thank you very much for your time. See you in the next lesson.